Welcome back. Here's another problem on dividend policy using Gordon's model. A company's total investment in assets is rupees 10 lakhs, 1 million. It has 1 lakh shares of rupees 100 each. Its expected rate of return on investment is 30%. That means R is 30% and the cost of capital K is 18%. The company has a policy of retaining 25% of its profits. So, if the retention policy is 25%, the dividend payout ratio will be 75. So, here the retention ratio is B. So, 1 minus B will be 75%. Determine the value of the firm using Gordon's model. All right. So, let's solve this. Profits on the firm's investment is 30% of the total investment, which is 10 lakhs, and that equals to rupees 3 lakhs. Now the number of equity shares is given. What is the number of equity shares? 1 lakh shares. So therefore the EPS, earnings per share, E, is 3 lakhs divided by 1 lakh equals to rupees 3. Alright, now K is given, K is 18% and R is 30%. So this is a growth firm. Now, so if B, remember the retention ratio is 25%. So retention ratio B is 25%. Then 1 minus B will be 75% or 0.75. So P is equal to E into 1 minus B, the whole thing divided by small k minus B into small r. Okay, so what is E? E is already found out, it is 3. 1 minus B, we found out it is 0.75. K is 0.18 minus B is 0.25 into 0.3 R. Alright, so you get 2.25 divided by 0.105 equals to rupees 21.43. So that is the market price of the share. All right, and so if you look at the market value, if you look at the market value of the firm, it is, by the way, there's a mistake here because the total investment is 10 lakhs. So it has 1 lakh shares of rupees 10 each. It cannot be 100. Okay, it is be 10 each. So finally, what is the value of the firm? The market value of the firm. The market value of the firm, okay, will be, since we do not have any debt. All right, we know what is KE. All right, we know what is KE. KE is 18%. There is no debt. So KE, always remember, when there is no debt in the capital structure, KE will be equal to KO, and KO is the overall cost of capital. All right, so so we you can find out the market value of the firm. V is equal to the operating profit divided by the the overall cost of capital. In this case, it will be 18% only. Okay, so that's how you solve a problem using Gordon's valuation model.